Hi, good morning, everyone, and welcome back to the last session of the unit Business Environment, in which we're going to be covering today the Learning Outcome 3, which is understand how economic environments impact on organization. Now, before I just briefly get into this learning outcome, I just want to draw everyone's attention on, the unit specification and what we've covered so far. We've covered learning outcome one, which was looking at essentially understanding, different forms of legal ownership of businesses, wherein we understood things like how companies have different ownerships, like sole traders, partnerships, limited, companies, limited liability companies. You looked at PLCs and stuff, and then we dwelled a bit deeper into understanding, what are the advantages and disadvantages of each of the different type of legal ownership of companies. And then we went into some of the roles and responsibilities when these companies are formed. We looked at things like the Articles of Association, AOA, MOA, and what will be the various functions and responsibilities which the directors and the owners of the company will have under the legal ownership. Now, in the second learning outcome, we went into understanding what are the external factors which impact the organization. So we looked at pestle analysis, we looked at predominantly SWOT analysis, or macro and micro environment in particular, and how these factors can affect the workings of a business. So in this case, we looked at various activities which could impact the business from outside, which could be things like environmental activities. Sometimes we call them as act of God. We look at activities which are related to economic activities, which could be, decrease, say, for example, recession. It could be the change in exchange rates, fluctuation in currency rates. So those kind of things affect the organization, all organizations in a particular sector from the outside. And then this particular learning outcome was more focused on contextualizing how do we see business organizations being affected by external factors, but from an accounting perspective, what we wanted to do was understand how these factors can be mitigated and looked at when we look at it from a point of view of accounting profession. Now, in the third learning outcome, again, we're going to be looking at generically first understanding, what are economic environments, what are the different types of market economies. We will also then understand, things like there is a lot of key terminology, let me put it this way, in this particular learning outcome. So we'll look at a lot of key terminology and cover that in terms of the basic definitions. Obviously, economics, the learning outcome 3 is related to economics, which is a very, very detailed and a vast field on its own. So here the idea would be to again try and contextualize some parts of what we study from a point of view of business environment, economic systems, looking at, various instruments which are available in order for us to be able to inform on the economic systems. The idea would be to try and look at then seeing how these can impact the business, and also from a perspective of, how these challenges can then be, obviously overcome. And some of them, we would try and relate them to, the accounting side of things. So the learning outcome in this particular, the indicative content in this particular learning outcome is quite vast. And what I've done is, in order to cover the indicative content, I've covered a lot of key definitions and concepts, primarily, and the key terminology part of it. And then the idea would be to try and delve into some of the assessment criteria which are given. And there are 4 in particular in this particular learning outcome 3, which is looking at 3 pass criteria and then 1 merit criteria, in which we have to look at comparing and contrasting, economic activities of a company, or 2 different companies in 2 different economic environments. So there's an example that I've taken, and there'll be some additional amount of reading that you will be required to do. I've got about 60 slides on this learning outcome, to be honest, but some of the slides I've tried to keep them, as pictures or diagrams or tables, so that they'll be easy for you to understand. And as I mentioned earlier, that, economics is a subject in its own, right. It is a vast subject. And here the idea would be to understand how the economic environment can impact the business, and some of the accounting side of things or practices that we do provide to businesses, and what could be the relation of such practices that we do or provide to our clients in relation to some of the regulatory bodies is what we want to understand, in particular in this context of the learning environment. So let's begin with looking at some of the slides. Hi, Orbit. Let's look at beginning with some of the slides, that are put together. And the idea would be to go through some part of this key terminology first, and that will help us inform, in terms of a lot of these, let's say, topics which have been given in the indicative content for this particular learning outcome. So we are going to be looking at in detail in terms of, what are economic systems. We're going to be studying in detail about the two main instruments which the Bank of England or any government has to moderate and, drive growth in the economy, control inflation, the interest rate. So we look at some of the instruments of fiscal and monetary policy in particular. And then we'll also look at studying the impact of competition policy on a chosen organization. So here the idea would be to try and understand some of the key acts and legislations which are coming into play, and how, the competition and competition watchdog, which is the authority, CMA in the UK, regulates and essentially, let's say, implements the anti-competition policy procedures so that consumers are able to get a very fair deal, and there is fair amount of competition in the market, which allows consumers to get lower prices and obviously, products and services from a variety of, producers or manufacturers. So these are the three basic content, but we'll cover a lot of key terms and terminology within this, so that at some stage, what we do is the idea would be to try and cover all these from an aspect of, ensuring that they are giving us a very good understanding in terms of what is economics, and obviously how is this coming into play as far as, workings of a business is concerned. So let's look at understanding, the key economic systems. Now, there are four economic systems in particular. The fourth one, which is the transition economy, has been introduced a bit later, but there are three basic economic systems in the world. So here, when we talk about different types of systems, what we are basically looking at understanding is that when we look at a system in general, what we are basically looking at understanding is that how does the society, the government, and the availability of resources, which is there, is then, put into some sort of a practice, or it allows the companies, the businesses to be able to produce goods and services, and then the selling of these goods and services to the consumer in a particular geography basically constitutes what is called an economic system. Because obviously there is buying and selling of, there is buying and selling of, let's say, products and services pretty much happening. And in this case, what will happen is that you will need to, essentially look at understanding how the economies, function, and, essentially look at how the trade amongst the consumers and, the producers or manufacturers essentially happen when we try and understand these market economies. So let's look at some of the basic features of the, different types of systems. So when we talk about these three basic types, I've kind of, tried to put the main key features of the different economic systems into a table. So when we look at free market economy essentially would mean that here, most of the ownership of, let's say, the firms and resources are in the private ownership. You look at, there is some sort of a pricing mechanism which is in place, which will allow the market to function in terms of demand and supply. You look at, the intervention from the government or policies would be done. If anything is to be changed or intervention is to happen, then it will be done through policies or government policies. There is obviously freedom of enterprise and choice. Consumer sovereignty is maintained. This type of free market economy is also called, laissez-faire economies, wherein, the government allows the market systems to take over. And in this case, the survival of the fittest, or, essentially the businesses or the entities will decide in terms of who will survive and, how the, say, products and services will be provided to the consumer. Now, in planned economies, there is public ownership of resources. So most of the natural resources, when you look at gas, coal, electricity, things like that, you would generally see there is public ownership of these resources. Defense is for example, one such case. You look at health service in the UK, which is public sector. Now, here there is emphasis on central planning in terms of the deployment of these resources to be able to provide these goods and services. So along with that, what you'll also see that there is price mechanism, which is sometimes of less importance because some of these services will be provided by the government, or because of the public ownership, the government will be actually exercising its rights to be able to provide these services. In some cases, you would see in some planned economies, there'll be no competition in certain sectors. So when you look at, although in the UK, National Health Service is a service provided by the government, and obviously, UK is a welfare state, but there is very little competition. Government does not restrict private players to be able to offer, medical health services in the UK, but there is very little competition between the two because given a choice, most consumers, most citizens would actually go and avail of the public services which are available. And then in some cases, they will also have an option to exercise, private healthcare. And that will be primarily because there are public-private partnerships between the NHS and other providers. And in some cases, some of these services are outsourced and provided through private providers. Then we look at mixed economy. So you have free market on one side, you have planned economy on the other side. In between, you look at, for example, some of the best features of both the economies would be available in mixed economy. So here, there is public and private partnership or ownership of resources. Price mechanisms and economic plans, are drawn up in such a way that, there are, let's say, less clashes, and it's more conducive for consumers. There is selective government intervention, and that is normally done through policies. Government controls, basically the market is done in such a way that it does not allow monopolies to happen. So if you look at in the UK a couple of decades back, or let's say a couple of years back, British Gas, for example, or BT was the main provider of, telephone services or telecommunication services, and British Gas was the main provider of, gas and electric services in the UK. But this sector was generally opened up, and government did not, government has, kind of promoted promoted competition to step in, and that means they've done away with monopolies. And here, the government allows free competition to happen in order for consumers to gain, because in this case, if competition is brought in, a regulator is also brought in by the government, and that regulator maintains and keeps a keen eye or close eye on a watch on the competition in the market. And because of the competition, consumers get choice, prices are driven down, and the regulator has the responsibility to be able to ensure that there are fair trading practices and rights of all the consumers are protected. We'll look at a lot of these various let's say market regulator agencies, which are sometimes also non-governmental organizations. They function on behalf of the government, but the government does not exercise full control on them, and they will be organizations like Ofwat, Ofgem, Ofcon. There are lots of these organizations in the UK which function and regulate the market as a competitor or as a competitor watchdog. There is the fourth type, which is transition economies, and these are economies in which normally you would see there's a process, or as the word itself implies, transition economies. What will be happening is that there will be countries or economies which will be moving from one particular type of economic system to another particular type, and this will not happen over time. This will happen over decades, and in this case, these are called transition economies. So when we talk about transition economies, we look at, a process of move. Say, for example, you look at Slovakia, Macedonia, you look at some of the Eastern European economies which are transitioning from being, following one particular system, but when they entered the European Union, they have, they have to follow some of the policies and embrace some of the policies of the European Union, and there is where we see a transition happening from one economic system to the other. So here, the process is moving from centrally planned economies to a mixed or a free market economy, and that is what we get to see in some of the Eastern European countries or Eastern Bloc of countries which have been which have become a part of the European Union in the last, a detailed slide on each of these economies, just to ensure that you have a good understanding in terms of what these market economies mean. And when we look at studying these economies or economic systems in particular, there are three key questions that we always end up asking, and these three questions tend to be what to produce, how to produce, and for whom to produce. So when you look at these three different or four different types of economic systems, we look at free market, planned, mixed, and transition. What you're going to be always looking at is answering these three questions which every economic system has to provide for, and these are listed in the slide. So what to produce, how to produce, and for whom to produce. So in the case of, say, free market economies, you would look at what to produce is determined by consumer preferences. That means consumer is king, the consumer demand is key, and here the companies would be looking at producing goods and services which are going to be in demand, and consumers would be looking to buy those goods and services. How they are produced, they're determined by, obviously, because it's a free market system, then there will be competition amongst different producers and manufacturers, and producers and manufacturers would be looking at making profits, and obviously this will set the pricing in the market. For whom it is produced from a point of view of looking at, where is the purchasing power. Sometimes you would see companies would come out with products and services, and they would be oriented towards a particular demographics because of the availability of, monies. And that is where you would see that producers, when they would be looking at producing goods, they will produce in a certain quantity for a certain type of segment, basis the affordability and the purchasing power, as we call it, PP, for the consumers in that market. So three or four slides essentially to explain, these particular systems. So you look at free market, command economies, or in this case, planned economies, consumerism, which is primarily, looking at planned economy, wherein most of the resources are, in control of. So basically in control of the government. So if you look at a communist economy, we think of China, we think of, economies like Burma or Myanmar in general, wherein obviously everything is in the control of the government. We talk about mixed economies, which is primarily, again, looking at an economy wherein obviously the market forces and central planning is done in coordination and in conjunction with, obviously the government. So here, what you would generally see, government policies, government, has very strong and, consistent policies to be able to grow the market. And that is where you see, obviously, mixed economies, functioning. Now, when you look at, the three economic systems, we also need to understand, from a system perspective, what are these economic systems essentially going to be able to provide? How does the market essentially function? So how is the distribution of resources happen? What is demand and supply? What is gross domestic product? What is the size of the economy? So this is a vast field, but looking at some of the key terminology here, what we'll do is go into some of the other bits which are given in the indicative content and try and understand them from a theoretical point of view. So after we know that there are three different systems, but in general now classified as four, if there is a transition happening, there are four different types of economic systems. And then what we look at is understand within the economic system, what is the economy actually producing? So when we look at what does the economy actually produce, or, what is the term that we use is what is the GDP of the economy. So GDP, or gross domestic product, is the value of nation's finished domestic goods and services during a specified period. So a GDP is a reflection of the efficiency of resources utilization in an economy. That means in a particular country. It also looks at giving us some indication in terms of what is the stability of the government. And it also looks at providing insight into how the functioning of the institutions of the nation happen. That means when we look at key sectors, when we look at key sectors like you look at, sectors like finance, you look at manufacturing, production, hospitality. So all these sectors and, how are they functioning within the particular economy would essentially, dictate what the GDP of the economy would be. When the GDP is growing, obviously you see the economic activities is increasing. There is prosperity, there is more income, the more disposable income available, and you would generally see that the country's currency is much more stable and stronger in respect to some of the other currencies, across different other economies. Now, here the GDP essentially is around the concept of GDP, gross domestic product, is related to a particular country. So it's an important measure for, looking at how the economies of the world are actually, performing. So when we say the GDP growth this year, the economy will grow by 2% this year or 3% this year. This is referring to the GDP growth or the gross domestic product. That means sum total of all the activities which will produce goods and services over a period of time would say that that would be the GDP. Now, we also come across a term which is called gross national product, or GNP. Now, this is the value of all finished goods and services owned by a country's residents over a period of time. So GDP is something which the economy produces, sum total of all the goods and services which the economy produces over a period of time. But GNP is the ownership of the sum total of all the goods and services. So the word ownership is important, and over a period of time. So here, the GNP differs from GDP because it is a reflection of how the distribution of resources are happening, how the skill set, people are, distributed in a particular economy. And then when we look at GNP, what you will generally see is that because immigration is one of the, effects which, so when we say brain drain, what tends to happen is that people who are economically more viable and have more stability would be able to immigrate or change and move to a different location because they want to be in an economy wherein obviously the economy is growing faster, there are more opportunities available, and there are more opportunities available for growth, development, and higher income. So when you see GNP vis-a-vis GDP, what you generally see is that if a GNP is growing faster than GDP, then what will happen is that denotes that people are the affluent, the intellectual, and the key workforce would actually tend to migrate to countries wherein the GDP, is better or is stronger because it provides for more opportunities for the individuals. So you'll normally see that GNP is used in developing countries more often because you see developing countries, like if you look at an example that I will give you here, which you will all be able to relate, is when you look at the Americas in general. When you look at America, what you generally see is that it's called the land of the free. And the reason why it is called is because a lot of people from different countries have immigrated to the US because of larger opportunities being available, the GDP being large, and the economy in general being free market economy. So here, what has happened is over the years, people have immigrated, and there is a brain drain. That means a lot of people have immigrated from India. Doctors, engineers have gone into organizations wherein they felt there were more opportunities available. And you generally see that a lot of these global organizations, they pick out and recruit people from countries wherein they feel the skill set is available, and that allows these people to also get better opportunities, and that is where the product GNP comes in. Now we look at another term, which is public finances and revenues. Now in the UK in particular, when we talk about public finances and revenues, what we are basically looking at understanding is that at any given point in time, when we look at public finances, it basically means the amount of receipts which the government actually gets by using instruments like taxation, value-added tax, personal tax, or basically any sort of corporation tax, for example, and that is basically public finances. So the money which the government is able to collect on from its citizens by taxation route, whether it's direct or indirect, different forms of taxation, that would be essentially government receipts. Now the spending of this money in the economy for infrastructure projects, or looking at development of let's say hospitals, railroads or airports and things like that, is basically going to be classified as public finances. That means the government would then spend money which has been received as receipts of tax from the citizens to be able to develop the infrastructure in the economy and put that money back into circulation, and that would be public finances. Now, in the UK, there are two bodies in general which maintain this particular activity and, keep a track of forecast and, keep a track of the activities which are happening, and also look at providing forecast and trend analysis in terms of how the economy or how the public finances are growing, how the government is able to, invest money into infrastructure projects or other projects, and how does this, pan out when the government looks at borrowing, from different sources, like the European Commission or the World Bank or the International Monetary Fund. Now, the Office of National Statistics, ONS, and Office of Budgetary Responsibility are two such bodies which basically keep a track of how the government is receiving money from its citizens and how the government is actually spending money on any sort of activities which it conducts in terms of running the economy in a country. Now, when we talk about public finances would be basically things related to tax collection, national debt, deficit or surplus, budget which the Chancellor comes out with, or in some cases, it's the finance minister which introduces the budget in the parliament in different countries, and then the expenditures which the government actually does, or money it plows into development activities of the economy, would all be a part and parcel of public expenses. Now, to give you a bit of sense in terms of how public finances and revenues are impacted, and how does it have a bit of an impact on the spending which the government does. If you look at, because of the COVID-19 pandemic, what has happened is the government has had to put in place a few lockdowns in order to deal with this particular pandemic. Now, what has happened during this pandemic is the government borrowings for most of the governments across the world have gone up. They've borrowed a lot of money to keep the economy going, to make payments to people or support businesses during the lockdown. And a lot of, let's say, schemes, lots of different types of schemes have been floated, and these schemes have required money. Generally, the UK government borrows anywhere between, 45 to 55 billion pounds on an average in a year, in a quarter, in order to run the various facilities and infrastructure side of things within the economy. Now, this borrowing during the COVID pandemic has gone in excess of 400 billion pounds. So if you see, there is a massive amount of borrowing which has been done basis the GDP or gross domestic product of the country. And over a point in time, the responsibility of the Chancellor would be to balance the books. That means to bring this borrowing down, to reduce the debt burden, and to ensure that there is fair collection of taxes, so that he's able to balance these books of accounts for the government. So in general, when we look at the public finances and revenues and the money which the government receives, or government receipts as we call them, it is the responsibility of the Chancellor of the Exchequer or the finance minister in most countries to be able to balance the book in terms of how much the government is borrow, how much the government is spending, and in terms of how much is it able to receive in terms of receipts from taxes, whether it's direct or indirect taxes. Now, at this stage, I'll also quickly relate this to, tax. So how does the government collect tax? So government looks at, obviously in most countries, there's a tax system. There is a system of taxes through which, businesses, organizations, individuals can be taxed, and this taxation depends on, different policies which the government has come out with. So here, if I have to put this into context, there are direct and indirect taxes. So in the UK, for example, you pay a vehicle tax, you pay a tax, you pay tax because you have a TV license, you're looking at road tax, lots of other different types of taxes. Now, these are indirect taxes. Direct taxes are taxes on your income, which would be income tax, capital gains tax. Some of these taxes could be indirect, like council tax that you pay, which pays further for the council, for these fire brigade services or hospitals, schools, and things like that. So when government looks at, or any such government looks at taxation system in the UK, it's a combination of, let's put it this way, tax, which is direct and indirect, and the tax is collected by HMRC. Now, in the UK, personal taxation, if you look at, the taxation rate varies from 0 to 45%. Personal allowances, income up to 12,500 is absolutely free. Anything over 12,500 to 50,000 is taxed at 20%. Anything from 50 to 150,000 is taxed at 40%, and anything over 150,000 pounds is taxed at 45%. Similarly, when we look at this into a bit of perspective from just understanding is that when we look at corporation tax, what you're looking at is the rate of corporation tax in the UK currently stands at 21%, and this is slated to rise in order for the Chancellor to balance the book, which is already announced in this year's budget, is that the corporation tax would rise to 25% by 2025, which will allow the government to receive more in terms of receipts from corporation tax, and that would allow the government, that will be one of the outlets through which the government will actually balance the books. Now, so the other terms that we quickly look at is inflation. Now, what is inflation? Inflation is the rate at which the value of currency is falling goes up or down, and that consequently has an effect on the prices of goods that you buy in the market. So essentially, when we look at higher inflation, you would generally see that the price of goods and services in the market rises. If you see a lower inflation, you would generally see that the price of goods and services in the market actually goes down. So here, inflation in the economy, the rate at which the currency is actually either appreciating or depreciating with respect to other currencies in the market, you would generally see this in the terms of, inflationary or inflation. And then the process in terms of how it affects the prices of goods and services in the market would be the inflationary process. So here, when we look at inflation, is when the inflation is sustained upwards, that means if the prices are going up, you would generally see that this will basically devalue the currency of the economy, and you would see normally prices at the stores, at the shops going up, which would mean that there is less spending happening, and you would generally see a bit of a there will be less money in consumers' pocket because they're paying higher price for the same set of goods that they would normally buy, and that would basically mean the inflation is, gone up. Now, to understand this, again, this is a very vast topic, so to understand this in terms of why it is important is because sometimes you look at, when we put this into a bit of context, in the UK, the Bank of England, Governor of the Bank of England and the Monetary Policy Committee, MPC, the Monetary Policy Committee, which has 9 members, they are responsible, for maintaining the inflation in the UK at a target of 2% or lower. So the Bank of England directly, the Governor of the Bank of England and the Monetary Policy Committee has a direct target to keep the inflation below the rate of 2%. Now, in the current example, if we look at in 2021, because of the pandemic and the recession and the contraction of the economy which has happened, the inflation is low. So what you see is the inflation in the year 2021 is 1.21%. This is slated to rise to 1.69% in the next year, and that would mean that at some stage when things start to open up, the economy starts to open up, you generally see that the prices begin to rise slightly, and this would basically be seen in the rise of the percentage of inflation, which will happen because the price of goods will rise and price of goods and services will rise, and that would consequently be seen as a rise in the inflation. Now, there's another term which we need to understand, which is called balance of payment. Now, balance of payment is basically a difference between all the money flowing in and the money flowing out of the country. So essentially, when we say you have to balance the book, and we look at the accounting equation also in terms of when we sometimes look at balancing of the books. So here, what you are basically looking at is talking about the money coming in and the money going out. So when we talk about the accounting equation, we talk about assets equal to liabilities plus equity. So in this case, what we want to be able to do is similarly when we look at this particular balance of payments, what we see this from a government's point of view is that how much of money the government has in terms of assets, and what that would be able to pay in terms of liabilities and equity, which is required in terms of, being able to buy products and services or take out loans or overdrafts when it does that borrowing from the World Bank, the European Union, or the International Monetary Fund. Now, here, in simple terms, what we need to understand is that sometimes when government looks at balancing the books, it also has to keep into account and take into account what is the money coming into the bank in terms of the government pocket from the receipts, which could be generally from taxation, indirect, direct taxes, and what is the money that it is spending. So if the money coming in is more than the money going out, then you see a surplus. If the money coming in is less than the money going out, that means government is spending more than what it is collecting, then you will see a deficit. So the balance of payment basically is related to two terms that we want to understand is surplus and deficit. And this is generally calculated by looking at the inflow and outflow of money which is happening from the economy. So balance of payments, there's an equation for it. It basically is equal to current account plus financial account plus capital account and the balancing item. So these are terms. If we have to look at a balance of payment equation, then this is how we will look at basically accounting for it. Now, the reason why we want to look at this term here is, as I mentioned earlier, we want to look at whether the balance of payments is happening or not happening, and that will reach through relate to a phenomenon of surplus or something called deficit. Now, these are the basic terms that I want you to understand before we get into all the basic assessment criteria. So we've looked at the key broad headings, which is economic systems. We have looked at some of the key terms within the policy, fiscal and monetary policy. We'll come to the actual policies in a minute because they are a part and parcel of your assessment criteria. And then we've looked at some of the key terms and terminology which is related to the competition side of things. Before I get into the assessment criteria, what I want to do is draw your attention towards slides 50 onwards, wherein I've covered some of the other key terminology which is important for us to understand this in this context. So here, when we talk about some of the acts which are mentioned in terms of the indicative content, there is something called the Competition Act of 1998. Now, this particular act was introduced primarily which prohibits agreements between or, let's say collaboration between different businesses to be able to create, some sort of an unfair advantage in the market. And that allows the business or businesses to be in a dominant position, and that actually harms the competition. So essentially, the government created this act in the UK, and there's an authority called the Competitions and Market Authority, CMA, which is basically a regulatory authority which does have a role, very key role. That means it basically regulates, the market in such a way that it allows competition to thrive. And if there are any complaints which arrive, then the consumers can actually go across and make complaints to the CMA, which basically further investigates the complaints of the consumer. Then we look at the Enterprise Act of 2002. Now, this is a key piece of legislation which was, introduced because it enforces the competition law and crack down on anti-competitive behavior practices. That means if two companies try to come together and have an arrangement within themselves to be able to compete and corner the market, the Enterprise Act of 2002 would restrict that kind of a, action or restrict that kind of a, move which the, companies would try to create, which would give them unfair advantage or some sort of a monopoly situation wherein they would then try and control the entire business or the entire market in terms of demand and supply. So the Enterprise Act essentially works to crack down on anti-competitive behavior conducted by businesses in the UK. That means sometimes we do hear like EasyJet and Ryanair, two different airlines. They try and do a bit of a fixing on the ticketing, and what they do is they basically create a bit of a consortium within themselves to provide prices and ticketing prices, and this way they dictate what the other airlines would need to price their tickets at. Now, if this is detected or if this is proven, then obviously the Competition and Markets Authority takes appropriate action, does the investigation, imposes fine, and this is seen as anti-competitive because the consumers are not able to get fair prices in the market because two companies are trying to drive the market and through the pricing mechanism. Now, there is another body called European Union, EC as we call it. This is an executive branch of the European Union. The European Commission actually is responsible for proposing legislation, implementing decisions, and upholding EU treaties or, trade treaties which the European Union has done with different countries, whether it's the World Trade Organization, you look at, NAFTA, which is in the US, you look at ASEAN, so some of the trade policies that they have done, and then their role is to primarily ensure that these trade policies, decisions which have been done, or pacts which have been created are then adhered to by all the European, all the signatories to the European Union or members of the European Union. Now, this commission looks at overall shaping the EU strategy. That means any new laws, policies which are introduced, monitoring of that has to happen, implementation of that has to happen, they do it. The European Union also then looks at coming out with a centralized budget. Countries which are a part of this particular, union, they have MEPs or members of European Parliament, which basically, sit in Brussels and obviously represent their constituencies and countries and states or countries or boroughs. And then, obviously the allocation of budget allows this to run as a single economy. So obviously there is fiscal union. That means most countries in the European Union, although Britain has exited now, European Union, because we are no longer a part of it. But most of the other countries, when you look at the other 26 or 27 member states, have a single currency, and there is fiscal union. Now, European Union has a president. That president is normally elected for a term of 5 years, and that is currently, Ursula von der Leyen, and she is basically the president of the European Union. So this is again some information because we want to understand key terminology related to this particular learning outcome. Now, there's another body called OFT, Office of Fair Trading, and this is again a non-ministerial government department in the UK. This was established way back in 1973 under the Fair Trading Act. This was replaced by the Financial Conduct Authority, later in 2007 or 2009, I think. And then this particular Office of Fair Trading, the intention of this particular non-ministerial government department was to make sure that, markets in the markets work well. That means they work in favor of the consumers. There is vigorous competition in the market, and obviously there is fair dealing, and then no companies are able to collaborate or, collude in terms of doing, let's say, pacts which will allow unfair advantage to them in terms of, controlling demand and supply of goods and services in the market. So it basically prohibits unfair practices such as rogue trading, scams, and cartels. And the role is primarily to ensure that, there is enough competition or rigorous competition in the market so that consumers are able to derive, benefit from, lowering of prices, because the competition effectively lowers the prices. We also have one or two key terms quickly going through. Director General of Competition, DGC. Now, DGC is a European body which basically is looking at, it's a commission which basically looks at competition policy in general across the European Union, and that, has a bigger role than the Office of Fair Trading, which is just in the UK. So here the idea is that the Director General for Competition basically looks at making sure that there is vigorous competition in the market, there is fair dealing amongst businesses, there is no profiteering amongst businesses by using things like rogue trading and, scams or formation of cartels, and it basically monitors all that. Now, there are a few other bodies that I've not gone into too much, detail, but I've just put them across as very brief. There are these bodies which I mentioned earlier, which are called regulators. They are non-governmental bodies, but they regulate, competition in the market, and they are specific for specific sectors. So there are bodies like Ofgem, which is the, the regulator for gas and electric markets in the UK. There is Ofwat, which is the Office of Water Services and Regulation Authority, and this body is responsible for the economic regulation of privatized water and sewerage services in England and Wales. And you look at, the Civil Aviation Authority. This authority is, again, a statutory body, and this oversees and regulates all aspects of civil aviation in the UK. That means it is responsible for areas which include supervising the airspace, pilot licenses, testing of equipment, calibrating of, various naval yards, and also many other inspections which it carries out, with regards to ensuring that there is primarily safety, for passengers, when they utilize these services. Then we look at, this is something which is important, we look at the Companies Act of 2006. Now this is something that we are aware of, that because of the accounting profession and the services that we provide, the Companies Act of 2006, essentially, simplifies and modernizes the corporate side of law. This act was introduced in the UK in order to bring reforms to the company law. And what it does is it provides the act itself has about 13, if I can remember correctly, 13 articles and 1,200 subsections or sections, which basically provide a rule book or like a guidelines to essentially companies and, other companies and, obviously business organizations in terms of understanding the role of directors, shareholders, and, how in general, let's say the key bits in terms of submission of statements and reporting of profits and other things have to happen. So basically, a body, which is regulating the formation of companies in the UK and England and Wales, and also providing, guidelines in order for the companies to be able to work, under the, the pretext of law. So basically, refined and modernized version of this is the Companies Act, which basically helps understand how companies can be governed by various laws and legislations in the UK. Now, with this, we cover, I think, I've tried to look at covering most of the key terms. Essentially, what we need to do is to understand, this broader area of this particular learning outcome. Now, going further, what we want to also do at some stage would be to understand, bits related to the individual assessment criteria. So let's go into this very briefly and look at, the first assessment criteria talks about explaining how resources are allocated through the economic systems. So when we talk about the three broad economic systems, the free market, the command economy, and the mixed economy, here we want to understand is, because this task is explained, so you're looking at about 50 to 75 words to be able to explain how these economic systems actually work and how the resources are allocated within these economic systems. So if you look at, I've created a few slides to explain this. So in the free market economy, resources are allocated through interaction of free and self-directed market forces, which is to say that, here the producers or manufacturers will produce goods which are going to be in demand by the consumers. How much is to be produced, for whom it has to be produced, and when it has to be produced. If you remember the three sides of the equation that I spoke about in terms of what is to be produced, we also talked about things like how much is to be produced or how it will be produced and for whom it will be produced are the three basic things that you will need to answer when we talk about these three basic systems. Then under the command economy, the government actually controls most of the economic aspect of the, resources or the output of the production of resources, which are, basically output of production, which is done through the resources. And the government here decides what would be the means of production, who will own, what industries are going to be privatized, what industries are going to be in the public sector and the remit of direct control of the government. And in some cases, you would look at, command economies would typically be, wherein some industries like the defense or, certain national infrastructure, let's say industries would be under the control of the government. So resources are controlled by the government. Mixed economies, obviously slightly distinct from the other two here. Obviously, there's working between the two side in terms of government has a very strong, presence, and the control in terms of resources and the output is done primarily through the intervention of government policies. So here in this case, you would generally see the government would actually, allocate resources predominantly for public sector services like defense, police, fire services, and some of the other sectors, which is wherein there's private-public partnership. You would generally see that the allocation of resources is done by a combination of market and planning. And then in some cases, an example of this would be, say, healthcare, wherein you would generally see in the UK, most of it is provided by the National Health Service, which is public, but the government does not restrict the private sector from providing these services. So there is a presence of private sector as well. And that is where, your market or mixed economies would come in. Now, When we talk about these three, what I've done is I've created a further few slides which explain them in a bit more detail, which is things like free market economies. And then the idea is to discuss the advantages and disadvantages. We look at planned economy. And in this case, we look at again the advantages and disadvantages. And then we look at mixed economy, which is where, we've covered that the government would normally look at, controlling some part of the output of the economy through the intervention and usage by its policies. So here, when we look at, in some cases, the first task, it is primarily to explain how resources are allocated in the economic system. So here, the idea would be to do about 1 or 2 paragraphs or 1 or 2 tables for each different types of economic systems, and that will help you as accomplish this particular task. Now, the second assessment criteria. Any questions at this stage, feel free to ask me, and I'll be more than happy to answer those questions. Now, the second assessment criteria is review the impact of fiscal and monetary policy on an organization and their activities. So here, what I've done is we will start across with discussing what is fiscal policy, and we'll discuss what is monetary policy. Now, when we talk about fiscal policy in the simplest terms is the use of government spending and taxation to influence the economy. So in simple terms, what this will mean is that it is an estimate of taxation and government spending that the government can do from the money that it generates from the collection of taxes and the money it spends in order to drive growth in the economy would be controlled, or it will be a measure which will be actually directed or controlled by using what is called the fiscal policy. Now here, as an example, if the government is to lower taxes, what you will generally see that it will put more money into consumers' pocket, which would lead to more spending. And in this case, what will happen is that more spending would mean consumers would have more money in their pocket, which would mean that they'll have more purchasing power, and that would mean increased spending in the market. And in general, the economy will, basically grow. Now, the aim of the fiscal policy essentially is the government's aim is to primarily ensure that it is able to stimulate growth in the market or in the economy itself. So if you look at after recession, like we had the financial crisis in 2007, 2008, 2009, what you generally see is that more government have kept the interest rate, which is the Bank of England interest rates, to record levels or at very record low levels. So here in this case, that has allowed money to be borrowed and money to be borrowed from the Bank of England at very economical rates, and this has allowed the the prices to be let's say the interest rates allow money more borrowing because money is available, cheaper money is available because of the lower interest rate, and that allows banks to borrow more money, consumers to borrow more money, and government also in tandem then puts a lot of things into place, like in the UK, in order to kickstart the economy after the financial crisis. The government introduced the first-time buyer scheme for the first-time buyers scheme, wherein the government essentially invested 20% equity, and you could buy a house in the UK by putting in a 5% investment, and the balance 20% was put by the government, and that allowed a lot of first-time buyers to get onto the housing ladder, and this basically started a construction boom. And when these kind of activities, which lead to the overall growth in the economy, is done by lowering the interest rates, making money available, and it's all done through the fiscal policy. Now, if we have to understand broadly and in detail, I've created 2-3 slides. So the purpose of fiscal policy, if you think about fiscal policy, the first thing which should come to your mind is the government is looking at stimulating growth. It is looking at keeping the inflation low, and the government's target for inflation, the Bank of England and the government's target for keeping the inflation is 2% or less. This policy is aimed at essentially, making sure that there is, stimulated demand, or there is, when I say the idea of this particular policy, by controlling the interest rate and the inflation, is to stimulate demand in the market. And when the government is able to do this, what you will generally see that they will use this to drive more growth, bring unemployment down, and generally you would see to essentially, let's say, put more money in consumers' pockets so that they spend more, and that would drive the growth in the market and the economy of a country. Now, fiscal policy can be of two different types. There is a loose fiscal policy or tight fiscal policy, depending on how the government actually looks at, implementing this in the market. So expansionary is loose, or deflationary is tight. These are the two terms that we use. So here the expansionary policy is to look at increasing aggregate demand. So the government here is looking at, let's say, let me just put the full forms of this. So the government is essentially looking at, stimulating demand in the market, and this is where it will make use of the loose fiscal policy so that it is able to drive the demand, government increases spending, in its projects, infrastructure, other, aspects of the economy, so that when they look at, growing the economy, they want to create jobs. So what the government will look at doing is they will start investing into the economy. They will cut taxes, and lower taxes would mean more spending and more disposable income in the hands of the consumer. Now, this creates a deficit for the government in its budget because it is collecting less than it is spending more in the economy in order to, stimulate growth. And that means the government borrowing will actually increase. So when we look at expansionary fiscal policy, we see objectives of the government to be able to drive demand in the market, lower the taxes, lower the interest rate, and that in return has an effect on the overall working, wherein the government would then try and look at balancing the books, because there is a deficit which will be created because it's borrowing more than what it is receiving in terms of tax receipts, and that would generally mean that at some stage the government has to look at increasing taxes, or increasing taxes essentially to balance the books. Now, the flip side of this policy is when the government looks at deflationary or tight fiscal policy. So again, here the idea is the government is trying to decrease the aggregate demand. The government is trying to cut its spending, but it is also at the same time, when it's trying to cut the spending on public infrastructure projects or other aspects of the economy, you would see cuts being made. Like in the recession, councils were asked to make cuts in the UK. There were cuts to the defense budget, there were cuts to the NHS budget, and the government was trying to save money. So when the government does this, what it does is also increases taxes. And the idea here is that in this case, the government is trying to balance the deficit which has been created by increased borrowing. And when they have a tighter fiscal policy, which means taxes would rise, and the government would basically look at balancing the books by getting more payments in through the receipts that it collects or the taxes that it receives. And in general, this would mean that the government's balance in terms of books would basically get better. Now, when we talk about fiscal policy, before we go to the monetary policy, there are three instruments in the fiscal policy, or three basically type tools which it is going to use. One is government spending, the second is taxes, and the third is transfer of payments. So when we look at these three different tools, essentially which are a part of the fiscal toolkit, policy toolkit, what these three tools essentially do is that they allow the government to regulate its spending, regulate its receipt in terms of taxation or receipts, money that it receives from taxes that it applies to corporations, individuals, businesses, and then allow it to transfer some of these payments to influence the aggregate demand. That means how, in general, the economy would essentially look at moving in terms of demand and supply with regards to that in the market. So when we talk about transfer of payments include things like in the UK, national insurance. In the US, it will be social security. You look at welfare payments or benefits, and then you look at, unemployment benefits and things like that, which the UK government would have when we look at transfer of payments or transfer payments. Now, these are checks which, can happen on a monthly basis, on a quarterly basis, and sometimes in the lockdown. If I give you an example, like in the COVID-19 pandemic, the government has introduced what is called a furlough scheme. There are welfare benefits which have been introduced, top-up payments for, senior citizens to their gas, electric, and gas and electric bills have been introduced, and these are all transfer of payments which will happen, predominantly because the government will be utilizing these to, stop the contraction of economy. And here in this case, what the government is trying to do is basically stimulate the demand by putting money received from taxes or from the generation of these taxes or cuts, which is it doing it. They're trying to deploy that money back into the consumer's pocket to be able to stimulate demand in the economy or to stay away from recession in the economy. And they would be the, three tools which the fiscal policy actually uses when it is implemented. Now, very briefly looking at what is monetary policy. Now, monetary policy involves the use of interest rates and changes to the supply of money in order for the government to achieve its objectives. So here, when I talk about the monetary policy, is the responsibility of the Bank of England and the Bank of England Monetary Policy Committee, MPC as we call it. It has 9 members, and the direct target of the Bank of England and the Chancellor of the Exchequer is to keep the inflation rate below 2%, which would keep a check on the prices, the flow and inflow of money into the consumer's pocket and in the economy in general, and that would regulate, what kind of prices you see on the end shelves or in the retail stores when you buy goods and services. So the monetary policy, since 1997 has been controlled by the Bank of England, and it has basically 2 main reasons or 2 main objectives. And these 2 main objectives tend to be keeping the inflation below 2% and ensuring that there is stable economic growth in the country. So this policy, if you see this particular chart, the monetary policy looks at regulating interest rate. And in order to keep the economy growing, the interest rates need to ensure that the inflation, the money and the rate at which the Bank of England provides money to other financial institutions in the market is done in such a way that the inflation rate is kept below 2%. Now, if the inflation begins to rise, then at some stage you would see generally the Bank of England would cut the interest rates, and that would basically mean that the inflation can be brought under control. Now, in some cases, if we see that if the interest rates are rising or if the interest rates are not making any difference and the economy is still declining or the gross domestic product is still declining, you would normally see, like in the financial crisis of 2008 and 9, the Bank of England introduced something called quantitative easing. And the quantitative easing was primarily providing money to financial institutions by increasing the supply of money in the market, which and at a very low interest rate, which allowed banks to borrow money. And in turn, also what they did was they bought the toxic debts or bonds and issued bonds in lieu of that for long-term duration, which allowed the banks to free them of their toxic assets or assets which were not performing. And the Bank of England has actually taken them up under the program of what is called quantitative easing. Now, how does this policy work? This policy is basically, looking at setting an interest rate at such a level which allows it to control inflation, and it also allows it to drive growth in the market. So when I say growth, that means one of the other things that is closely related to monetary policy would be the rate of unemployment that, it can have, the effect on the rate of unemployment that it can have as far as the economy is concerned. So if they change the base rate, what tends to happen is the interest rates in the economy would, if I look at the base rate, which is now currently at 0.25%, 0.25%, you would generally see that they still influence how savers are looking at saving, how mortgages are moving in the market, and what in general are the lending rates between the banks when they look at borrowing money, from financial institutions to be able to provide that free flow of money to consumers and in the market in general. Now, there are various aspects which I've explained in terms of how does the Monetary Policy Committee set interest rates, what is quantitative easing, what is the effect of having a looser monetary policy and a tighter monetary policy. The reason why they have been done is primarily for us to be able to understand, what kind of an effect does it have on businesses in general in the market. So if we see, looser monetary policy, that means the government is exercising let's say, is basically having lesser control and wants to ensure that the inflation should come below the target of 2%, then what it is trying to do is basically look at driving economic growth by looking at implementing mechanisms which are going to be loosely controlled through its policy. And in this case, they are trying to stave the economy from falling into what is called recession. So in most cases, when you see loose interest policy, monetary policy, you would see the government actually cuts the rate of interest, or the Bank of England cuts the base rate, and this allows, in theory, cheaper availability of money to happen in the economy and to the banks, and which in general starts to put more money or more disposable income into the pockets of consumers, and that is where it encourages spending. Now, tighter monetary policy would mean that the bank feels that the economy is growing too quickly and the inflation is rising above the target of 2%, which is the government's target, and what it is going to likely then do is increase the interest rate in order to reduce the economic growth. Or let's say, in my case, I would put it this way, that it would mean that they are trying to look at reducing the inflation, which is going outside the target of 2%. So increasing interest rates would mean slight fall in consumer spending. It would also make things much more expensive in the market when we look at mortgages in particular, and that would mean that the businesses would look at investing cautiously, and this then helps the government to basically control the economic growth in the country. Now, these are also explained by some slides. What I want to do is basically, rather than you read through a few slides, what I will try to do is basically make them visually more understandable. And main challenges facing Bank of England, which is the main central bank in the UK. You have the Fed in the US. You have, say, for example, the Reserve Bank of India in a growing market economy like India. And you have similar banks in China and other places which are called the central banks. Their main challenges are always to control inflation, making sure that there is sustainable economic, activity happening in the country. Their aim is to ensure that the government is able to rebalance its books and ensure that there are, investment coming into businesses, which is foreign direct investment, or FDI. And the role of the regulator in general is to ensure that the banking system in the country is very robust and secure. Now, these are explained why and how, you would normally see the use of fiscal and monetary policy being done by the government or by the central bank in order to stimulate growth in the economy. So when interest rates fall, what happens? You look at consumers getting more money in their pocket, prices tend to reduce, and the government is trying to reduce unemployment, and that is where it is following either a loose or a tight, inflationary or expansionary monetary policy. Now, if interest rates and they begin to rise, you generally see people trying to save more, spend less, because things are, the goods in the retail stores and the shelves would become expensive. People will start to save money, and in this case, it starts to drive the growth down. So these are bits that I've explained using, some of these slides, which would be easy for you to read and understand to finish and accomplish, learning outcome. The assessment criteria 3.2, which talks about essentially, explaining what is the impact of fiscal and monetary policy on an organization and their activities. So here, after understanding what is fiscal policy and monetary policy, my suggestion would be to take up a particular business and explain how the business contracts, or business decreases and increases during recession or boom, or in some cases by the use of fiscal and monetary policy. So in this case, it could be an example of using in a business which is doing export and imports. So if the interest rates begin to rise, you see inflation rising, you generally see the exports falling, and if the vice versa happens, you would see imports rising and exports rising and imports falling, and that is what you would need to explain to cover this task. Now, in assessment criteria 3.3, we need to look at evaluating. Basically, it is evaluating. That means we need to show by an application the impact of competition policy and activities of a specific or contrasting organization. So here we need to take up a public sector or a private sector organization, depending on the legal ownership, and then evaluate them to understand how the competition policy impacts their day-to-day functioning or their business activities. Now, the main aim, as I mentioned earlier, of competitions policy is to promote competition in the market. It wants to make markets better, and it wants to ensure that the markets can, move towards more efficiency. And the authorities like the CMA, as I mentioned earlier, the Enterprise Act of 2002, ensure that there is fair competition amongst various players in the market, and this allows companies to do away, or the regulators to ensure that there is no monopoly or duopoly, and there is fair competition in the market, which allows consumers to get choice, and it also allows the price to be driven down, which makes things much more affordable to consumers. Now, when we talk about competition policy, the main aim here is to make sure that there are technological innovations which are happening, which promote efficiency. It provides and ensures that there is fair competition amongst various suppliers, and it also safeguards and promotes the consumer's interest in terms of driving the price down. Now, there are 4 pillars that we understand of the competition policy in the UK, and these include antitrust and cartels, market liberalization, state aid control, and merger control. Now, these are 4 aspects through which the policy is actually rolled out. So the government actually looks at ensuring that there are no cartels which are formed, or no price fixings which can be done by 2 different companies to corner the market and get an unfair advantage. Liberalization tends to be wherein the government wants the sector to be opened up, more competition or more players to essentially come into that sector. So the government in some cases also provides soaps or, let's say, temporary reprieve from taxes, or favorable conditions to be able to set up the business, and this is generally done to do away with monopoly or monopolistic side of workings of a company or an industry in the market. So when you see liberalization over the years, the government has liberalized or opened up, as I say, the energy sector, the retail banking sector, the postal services. So if I give you one such example, in the UK, Royal Mail was the only, main service provider of postal services. But over the years, because of competition watchdog and markets authority, you see DHL and other private providers have also been allowed to come in and, offer these services. And it is left to the consumers to be able to decide which service they want to use. So there are lots of different types of, ways through which the government has looked at liberalizing. That means opening up of the sector or the market to allow competition to step in, and that allows consumers to get choice, and at the same time, reduce prices. State aid control. So in this case, sometimes you see certain sectors which are struggling and they require subsidies. So the state aid control would be used to provide these subsidies to certain sectors like the farming sector, the airline sector, and in those cases, the government's aim is to protect jobs, to ensure that these services or the sector is able to survive and is able to not have an unfair disadvantage from the other markets, because in other countries or other places, if there is subsidies being offered, or government is coming to aid the business to survive, then in those cases here also this can be done through this particular state aid control. Merger control tends to be the government here as a competitions watchdog, which basically looks at the CMA, which looks at the mergers and acquisitions between companies. So the idea here is that sometimes if 2 companies decide to merge operations and that is being purchased because of the reason that the other party is looking at is eliminating competition, then in this case the mergers control or this side of the key policy pillar would allow the regulator to step in, conduct a scrutiny, whether this will eliminate competition, whether this will create a monopoly for the provider, and depending on those circumstances, it may decide that it will not allow the merger to go through, because it is going to create a large organization by merging 2 competitors together, which would give them unfair advantage or monopoly in the market and would end up reducing the choice for consumers in the long run. Now, there are lots of main regulators. Obviously, apart from the CMA, there is there's a regulator called the European Commission, EU Commission's competition watchdog, which is primarily going to regulate what CMA does in the UK with regards to the competition side of things. Now, when we look at examples of competition policy in action, we need to theoretically also understand what is deregulation, what is privatization, and then we also need to understand, what are laws which are applicable in the case of anti-competitive behavior, and then how does it help in the reduction of import controls. So when we talk about competition policy, deregulation tends to reduce laws and reduce, monopolistic power. That means if you look at in the UK, British Airways, if I look at going back 2-3 decades back, British Airways was the main airline, and it had a lot of state aid and control, and that it had a bit of a monopoly. Now, when Virgin Airways started, it tried to challenge that particular monopoly, wherein the government opened up the airline sector, and that allowed many other airlines to come in and provide those services, which made choice available, lower prices available, more, destinations available to consumers to be able to book tickets. So here, sometimes you look at competition policy works in favor of the consumer, because here the idea would be that it will basically not allow a company to own that particular sector, wherein it allows it to work like a monopolistic player. So in this case, the competition watchdogs, for example, the British Airports Authority, BAA, has been asked to sell off some airports because it seems to have absolute monopoly on the management and the services that it provides to various airports. So Heathrow, Gatwick, Manchester, some of the big airports that it has, Edinburgh, Glasgow, it has been asked to sell off some of these airports to other competition players, which will allow competition to step in, services to be improved, prices to be driven down, and given choice to consumers. Now, privatization, transferring ownership, stock market reflotation for Royal Mail, Network Rail operator, Network Rail in particular, you look at BT. So these are other aspects of competition policy. Now, when you look at BT was the main provider of services in the UK, and BT's own company was the main provider. BT Openreach was the main provider or infrastructure solution provider for, the broadband, telecom, and other related services in the UK. So the competition watchdog essentially, after conducting the investigation, kind of forced BT to privatize and separate its infrastructural operations so that they can provide fair and free services, in terms of maintaining the infrastructure. So BT has its own infrastructure, but BT Openreach now looks at maintaining and providing these services to all such operators like Virgin, PlusNet, lots of other operators, Sky, and, Vodafone, and all these others. So the infrastructural side of division was then privatized or asked to be privatized by the competition watchdog. And this allows, the access to these services to be made available to other companies when they go out and go to market. So when we talk about tough laws on anti-competition behavior, the two acts, the Enterprise Act of 2002, this Competition and Markets Authority, CMA, they come into play, and they ensure that there is anti-competitive behavior as far as the the organizations are concerned when they're working in the market. So here they impose fines if they find infringements happening, or if they find collusion happening, or if they find collaborative arrangements or cartels being formed in order to drive prices in the market. And their role is to look at maintaining and ensuring that there is no such practice which is created in the market and allows free and fair competition to prosper. Now, when we look at this particular assessment criteria here, the main idea is to primarily understand the impact of competition policy on an organization. So for this to happen, what I have basically looked at is a bit of a case study, which I'm going to, provide. And that would be looking at, you understanding how, two organizations can actually be impacted by the competition policy. Basically, the application of the competitions policy has to be seen, with regards to, this particular task. So refer to the case study or handout which I'm going to provide on Moodle in order for you to complete this task. Now, in 3M1, which is the last assessment criteria with the merit criteria for this particular learning outcome, it talks about discussing the challenges which the organizational activities can have in different economic environments. So here again, this is an application part wherein you have to take up an example company. In this case, I've taken up Ryanair, and you have to explain how the activities of the organization can be impacted in different economic conditions. So for example, recession, and we look at boom. So during boom time, how the company services, the revenue, the basic, let's say, the operations of the company actually thrives. And when we look at recession, how the company gets affected, how its operations gets affected, how the pricing gets affected, what kind of outcome does the consumers have, and that has to be explained with regards to this particular merit criteria. So taking the example of boom, that means, the economy is thriving. In this case, what you will generally see the profitability of the company would grow, the company would hire more employees, the business would be doing well, it's spending more money, it's providing more services. It is, that would mean if employment is higher, people will have more money, more people are employed. That means increase of wages can also mean that in this case, if the company is doing quite well, the services, flights are going full, it is outselling its tickets in terms of demand, then you would generally see that it will employ more people, pay higher wages. Maybe there's a wage increase which is done for the employees in the company, and that would in general mean that the consumer is spending more. So this is the boom side of things. And when we talk about recession, it's the opposite, wherein the economy is contracting, the demand is less in the market, it's slowing down, there are lower incomes, the company is looking at making redundancies. That would mean that the unemployment rate would rise, and that in general would mean if the demand is slowing down, the tickets sales are falling, that means there's a decrease in consumer spending or demand from consumers in terms of flying to different destinations. So if you look at the COVID-19 pandemic, obviously air travel is restricted. There are air corridors restrictions in place because travel is not allowed. In some countries there is fine, like in the UK, if you travel abroad now, there is a £5,000 fine if you travel abroad for holidays. And in general, what you generally see is that the whole economy is, on this side, the operations on this side is standstill. I think a couple of months back, when you look at, some of the news articles, you would have seen that a lot of these airlines had actually asked the government to provide a bailout package. EasyJet, British Airways, Virgin Atlantic, Ryanair, because they had lots of planes grounded because of the lockdowns. There were no flights going at all, and that has meant that the companies had to fall back on their retained profits to be able to stay afloat or the businesses to remain viable. And in those cases, what has happened is they've laid off a lot of staff. Like British Airways has laid off 12,000 staff during this pandemic, or at least have looked at making some of the staff from full-time to part-time, offered involuntary redundancies or golden handshakes, as we call them, so that people could be, they could reduce the overhead costs. And this is primarily the effect of, recession or no demand in the market. So this bit has to be compared, for a particular organization. And that has what I've done with the few slides for Ryanair. Now, there is another handout which I'm going to provide, which will allow you to look at a different perspective, wherein what we are doing is basically comparing the challenges of selected business activities for different organizations in different environments. So I've taken an example of Ryanair versus, say, British Airways in this case. You could look at another example of Tesco versus McDonald's and how they operate in two different business environments or two different countries, and how you see that they are affected by, basically affected in terms of, the challenges that they face when they operate in different economic environments. And this would help accomplish this particular side of the, assessment criteria, which is 3M1. So I hope with today's session, any questions on today's discussion that we've had so far, so please let me know. Okay, now, so with this, as you can see in today's discussion, we have covered Learning Outcome 3 in a bit more detail. I know the lecture's gone over a bit of time today, but the idea is because there was extensive indicative content, the idea was to try and look at covering most of the topics through our discussion, and I hope this has given you a good amount of understanding. And with the additional handouts that I would provide on Moodle, which will be the 2 case studies for the task 3.3 and 3M1, they will allow you to show and use those case studies to show the application in terms of, completing those tasks as well. If you have any further questions or any queries related to today's session, feel free to drop me an email at raman@ukversity.co.uk, or, we will catch up with regards to the assignment discussion session next week to discuss the assignment, and the tasks in the assignment brief in more detail. Thanks so much for attending, and bye for now.